Good morning, everyone, and welcome to the Daily Trader with Kevin Hincks. I've got two paper money trades for you today on two high-profile names, both with earnings coming up on the horizon. I've got Boeing, which has got earnings tomorrow morning, and then Google Alphabet, which is Thursday after the close. So let's get to our first trade of the day, and that is Boeing. The airliner has some news today, selling one of their divisions, the Jeppesen Navigation Unit, to Thermo Bravo for $10.55 billion, all cash deal. That was announced this morning. But the biggest thing is earnings coming out tomorrow, and let's look at earnings. So we're going to go to the May 2nd expiration. We're going to buy a call diagonal. We're going to buy the 165 call, and then looking at the expected move of about $8.50, we're going to go out and sell the April 25th 175 call for, that net. Buying the 165, selling the 175. We have that in for about a 425 debit, trading about 365, 370. So the stock is backed off a bit since the open. So this diagonal is actually trading less. Now, there's a reason it's trading less. It's a couple dollars out of the money. Boeing is only up a little over $1. It traded as high as 163 today. The 165, 175, a little bit of a bullish tone in Boeing there because we're a little higher than the expected move. But if you don't think that's the case, move those strikes down. Remember, the expected move, about $8.50 for tomorrow morning's earnings announcement. So the risk on this trade, whatever the debit paid, and the target is the 175 strike. So if you think 175 is too far, lower those strikes, tighten them up, or just lower both of them together. But the risk on this trade on any diagonal is the debit paid. You're collecting theta, you're buying an aggregate implied volatility of around 60, selling an aggregate volatility of around 84, so you're taking advantage of the dispersion between the two implied volatilities. Buying a call diagonal in Boeing. Let's get to our second trade, and that is Google Alphabet. Now, they don't have earnings till Thursday after the bell. We're doing something somewhat similar, but not similar. Something in the calendar spread family, but this is a true calendar spread, but this is a more complex trade. That means we're combining two trades to make one complex trade. We're selling the April 25th 144, 140 put vertical, taking that credit and buying the May 2nd, April 25th, 157.5 call calendar. So buying the call calendar, selling the put vertical. We put that in for about the whole package, all four sides, in for a net credit of about 25 cents, trading right around there, 22, 25 cents, right around there. But this is a trade that you're doing for a credit, so it has no upside risk if Google Alphabet were to move to the upside. Your target is right in line with that expected move, about 157.5, the expected move in Boeing, about $8. So you're right on the nose for that expected move in Boeing. On the downside, you're a little aggressive. This is a bullish trade in Boeing. Selling the 144, 140 put vertical, that's the risk on this trade, is that $4 minus the 25-cent credit you took in. So the risk, about $375 on the downside if Google Alphabet were to break $140. So a complex trade in Google Alphabet, buying the call calendar while also selling the put vertical for a net debit, or a net credit of 25 cents. So buying a call diagonal in Boeing, doing a complex trade in Google Alphabet, selling the put spread, buying the call calendar. That's our show for today, everyone. Have a great day. We'll see you tomorrow with another edition of The Daily Trader. I'm Kevin Hincks.